Hello, thank you for spending time with me today. Are you a highly paid employee who normally makes catch-up contributions to your employer's retirement plan? If so, you may be affected by a provision in Secure Act 2.0 that requires highly paid employees to make their catch-up contributions to a Roth account. This new provision has caused a lot of confusion and uncertainty. Some people are wondering if they will still be able to make catch-up contributions at all, while others are wondering if they will have to pay taxes on their catch-up contributions. Today I will explain the new provision, and we will talk more about the new provision and how it might affect you. So what's causing all the confusion right now? Well, when Congress signed Secure Act 2.0 on December 29, 2022, they accidentally deleted a section of the tax code that allows catch-up contributions for retirement accounts for anyone age 50 or older. So what they did here was totally shut down catch-up contributions altogether so that absolutely no one can make catch-up contributions anymore. As of July 2023, Congress has not fixed this mistake yet, but they should be able to fix it by the time mandatory catch-up contributions kick in at the beginning of 2024. Or if Congress doesn't fix it, the IRS might just ignore the mistake and continue to allow catch-up contributions anyway. What Congress was actually trying to do is force highly paid employees to make their catch-up contributions with after-tax dollars only. If you work for the same employer that you worked for last year and that employer paid you more than $145,000 in the preceding year, you will have to make your catch-up contributions to a Roth, which means that you will have to pay taxes on catch-up contributions now versus when you actually retire. The $145,000 is indexed for inflation, so the limit will change every year. Basically, the government has made this change in order to raise more tax revenue. Some people are calling it Roth-ifying catch-up contributions for highly paid employees. So what happens if an employer doesn't have a Roth option? Then highly paid employees would not be able to take advantage of catch-up contributions with that employer. Since employers are not obligated to offer a Roth option, your only hope would be that the employer would establish a Roth option for catch-ups that would be mandatory for highly paid employees and optional for other employees. Here's where things might get really messy though. Employer plans that accidentally discriminate in favor of highly compensated employees must either issue refunds to the highly compensated employees, make additional contributions to non-highly compensated employees, or do a combination of both of these fixes. For example, if your employer refunds contributions to you and you are a highly compensated employee who is over the age of 50 and you have not maxed out your catch-up contributions for the year, the employer would have to move the refunded contributions from the before tax category over to the Roth after tax category. Your employer would move an amount up to the catch-up contribution limit. After all is said and done, you would have to come up with the money to pay the IRS for taxes on the amounts that were moved from before taxes to after taxes. As I mentioned earlier, when you check to make sure that you are not exceeding the wage limit, it is only for wages with the same employer. So if you are a highly paid employee and change to a different employer, it looks like you won't be subject to the limitation for the year when you start a new job. In this case, you would be able to make your catch-up contribution before taxes. Now, it seems that Congress also made a mistake when they wrote Secure Act 2.0 by saying that the limit applies to wages. Roth-ifying seems to hurt W-2 earners the most because most business owners don't have W-2 wages, or they can manipulate their wages slightly. For example, S-corporation owners normally take W-2 wages and distributions. So an S-corporation owner could possibly take $125,000 in W-2 wages and stay under the wage limit and take additional funds from the company as a distribution from profits. This would allow an S-corporation owner to make their catch-up contributions before taxes. The business owners who can simply ignore this new provision are sole proprietors, LLC members taxed as sole proprietors, and partners of partnerships. These business owners don't receive W-2 wages at all, so their self-employment income is excluded from the wage limit. So as it stands, these business owners can continue to make their catch-up contributions before taxes. The IRS hasn't put all of the Secure Act 2.0 changes in place yet, so they may come up with additional requirements or make some changes. My prediction is that Congress will reestablish the deleted section of the tax code to allow catch-up contributions to continue, and they will expand the definition of wages to include the income of business owners so that catch-up contributions will be Rothified for business owners as well. If you want to know more about the tax consequences of your retirement funds and required minimum distributions, please watch the video on your screen. All the best to you.